In the last video, we looked at the banking amendment bill and how banks actually determine how much they're going to charge on interest, how much interest they're going to charge on loans that are taken. Today we're going to be looking at how does that interest capping that was put into law affect borrowers. This is going to be an interesting one. This is Money Wise with Rina Hicks, where we create, grow and preserve wealth. For those of you who have no idea what I'm talking about, this is what happened. 2 weeks ago, the president signed the bill that proposed an amendment to the Banking Act that says that for lenders, all financial institutions must lend at a capped rate. And this capped rate was determined as follows: that it shall not go above 4% of the central bank rate, reference rate, CBR rate, and the CBR rate is currently 10.5%. So your loan cannot go above 4 percentage points of the CBR rate, and which is currently at 10.5. So loans are now all capped at 14.5%. Well, as the CBR rate changes, that rate will change, but it will be capped at 4% of that rate. Now, on the other side, with savings, it was determined that savings will be 70%, will receive an interest rate of 70% of the CBR rate. Currently, the CBR rate, as we've mentioned, is 10.5. So 70% of that works out to be about 7.35% or thereabouts. And so really that's what it is. So it then puts a margin that is fixed on how much banks can make. On the side of the amount they have to pay those who deposit money, the depositors, they have to pay a minimum of 7.35%. And for lenders, they have to then lend money at a maximum of 14.5%. So that's really what we're talking about. Whereas before, they could lend, and we saw banks lending, and not just banks, but financial institutions lending even 20%, 25%, 30%, depending on your risk profile. The bank will determine how much they're going to lend you money. And depending on how much collateral you're giving them or security you're giving them, if you're taking a personal unsecured loan, for example, a bank will lend you money at 25, 30% just to take care of the risk element in the loan that they're giving you. So really, what does this mean to you as a borrower? So this is my view. My personal view is it is great that we can now access capital at a cheaper rate. But the question I have is it really available? Will it really be available? Last show we looked at what are the components that banks consider when pricing their loans. So we looked at there's the cost of funds, there's the admin fee, there's the non-performing loans that they have to consider, as well as the profit that they have to make. So that rate they were charging you before has taken into consideration all these different things. Now, if they're to reduce from the 20% they were lending money to about 14.5% as the maximum they're charging, something has to give. So as far as I'm concerned, either we're going to see banks reduce their staff and administration costs to a minimum to be able to save on that cost, or they're going to have to reduce the amount of money that they put aside to cater for non-performing loans. And really, what does that mean? It means that the quality of loan book has to be amazing. And what does that mean to you and I? It means that only those people who are credit worthy and those people who can repay loans comfortably will be able to access loans. Others who had no credit history or perhaps were not able to get loans as easily because of the fact that they don't have security, you don't have a logbook that makes sense, or you don't have a property somewhere. How are you going to be able to borrow is the question, because they will not be able to price in the risk. Or at least right now, I don't even know any bank that has figured out how they're going to be able to price in the risk to take care of this 14.5% maximum rate that they're going to give. So if you have a loan and it's a personal unsecured loan, the truth is, I don't know whether your bank will know how to price that unsecured loan in this new environment. So be prepared. You might receive a call from your banker telling you that they have to call on those loans. In fact, I don't know whether you took time to read the fine print in your loan document. It said, should regulations change or something like that, we have the right to call on your loan. So what that means is, I'm sorry to tell you, is that the bank has the right to call you and tell you, that loan I gave you for 2 million for that car that you bought, could you please pay up now because the circumstances have changed. That is another effect that we as borrowers are likely to see because of this interest rate capping. So it's not all hooray, there might be some issues, so let's be prepared. So while it's awesome that interest rates have come down, the question I'm asking myself is it going to be easy, or as easy as it's made to sound, to get that money? I wait to see. Let's share. If you've gotten a loan at the 14.5 that I've seen advertised on text and on the media, it would be interesting to hear what your experience has been. If you've also gone to get a loan and you've been told, sorry, you don't qualify, I'd also like to hear from you. Let's keep the conversation open so that we help one another. But one of the things I certainly know is that a lot of people are going to be pushed to borrow money from institutions that are not defined as financial institutions according to the Central Bank Act. And those are institutions that are either microfinance institutions that are not deposit taking, or SACCOs, or Shylocks. Those are the guys that are going to make money as far as I am concerned. So I wait to see how this pans out. And yes, I have released a book, so please click on that video, and I was at this side, I'm not too sure. And you'll get to know more details on when we're going to release it. So God bless you, and I wish you all the best. This is MoneyWise with Rina Hicks, where we create, grow and preserve wealth.